Good afternoon, everyone. I'm Pamela Hastings, and we welcome you so warmly to another Barometer Readings webcast. On today's webcast, we will be joined by our very own in-house expert, David Burrows, our Chief Investment Officer here at Barometer Capital, who will be pleased to provide us with a macro overview. And of course, at the tail end of his conversation, happy to address your questions, especially in this volatile market. So don't be shy. Please email me at phastings@barometercapital.ca or hit me up via Zoom on the Q&A or the chat. And on that note, I turn the conversation over to David Burrows. Good afternoon, David. Great to see you.
Hey, Pamela, thanks so much for hosting today, and thanks to everybody for tuning in. We do these once a week for a couple of reasons. One, to help people understand the way that we look at the world, to talk about some of the observations that we make in our daily work on sort of the macro environment, to talk a little bit about how that impacts our positioning and portfolios. Frankly, it's a tool to be transparent, to help our clients to know that we are doing what we say we're going to do. We are big believers in understanding the message of the market and making sure that we stay in tune with that. So on that note, October never fails to disappoint. September and the beginning of October, seasonally, the two most difficult periods in the year, almost invariably. If somebody was cautious or concerned about the way that the year might finish up, this is the time they worry about it. More often than not, we know that October, November, December is positive, but we have to see that get borne out in the numbers. With that, why don't we start just sort of from a high level view. As always, we like to take a 30,000-foot view of what we see going on in markets. And this is a chart I've been using for years and years. And it just highlights in dark blue the periods where the equity asset class has had a tailwind for an extended period of time. We call those secular bull markets. In secular bull markets, whether we're looking at the one in the 1920s or the 1950s and 60s or the 1980s and 90s, or frankly, from the period of 2013 on, the market doesn't move in straight lines. We have corrections. It's sort of like 4 steps forward, 1 step back. They tend to be very productive times to be invested. By the time we get to one, generally it's after a period where the market's had a very difficult go. People have very little confidence in equities. And it takes a long time for them to build that. But at some point, the asset class winds up over-owned and overpriced. And then the tide goes out and money flows somewhere else to another asset class or asset classes, until you get to a point where energy's built up enough energy in earnings growth and so on to fuel another bull market. So we started this one in 2013. There have been several interruptions along the way. We've been going through one over the last 20 months, but we do strongly believe that we remain in a structural bull market, and what comes after cyclical bear markets is cyclical bull markets. If we look at the last 2 structural bull markets under a microscope, we know that there have been these periods where markets corrected. This is 1990-91, where we pulled back about 20% top to bottom, 21% over about 18 months. 1994 was more of a time correction. 1998 was the Asian currency crisis, which was pretty scary. That was long-term capital getting into difficulty. And though they're all difficult to go through, including the one that we've been in, 22 months, we're still about 11% off the highs. It started in December of 2021. The reason that we try to discern whether we remain in a structural bull market or not is that in structural bull markets, what comes after these cyclical bears, are 3-4 really great years, which is where long-term numbers come from. Your nearest term number has the biggest impact on your return over time, and we have to manage our way through these periods. But most importantly, we have to be prepared for what comes next as we come out. So far, the bull market up to September, that we believe started in October of 2022, with the bear market leading up to that point, has been very short, and the amplitude has been very low. In other words, not much return so far. Market's been fighting against a Fed's tightening cycle and worried about lots of geopolitical risks. But nonetheless, the market has slowly been working its way higher. We've been going through probably that sort of average 10% correction over the course of a year. Markets pulled back about 9% off the highs. That was the beginning of August. If we look at the S&P price chart, here's the high that we put in December of 2021, and a series of lower lows and lower highs, leading to the low on October the 6th. And since then, the market has been in this channel working its way higher. And, certainly it has not been a straight line. There's been lots of pullbacks, including the one that we're in now, but we continue to be in that channel. Now, we have to remember that the S&P is dominated by, a few really big companies. If you put tech and communications together to include Google and Meta, it's 35% of the S&P, and that's a big piece. But so far, we remain in that channel, and we're coming down and testing that 200-day moving average, which is rising, and the 150-day moving average continues to rise. And we'll see we are coming into the sort of the seasonal low, which tends to be in the second week of October. When we look at the QQQ, which is of course heavily dominated by the largest tech stocks, even more so than the S&P, remains well above the 200-day moving average, above the 150-day moving average, but did come down out of that channel. And we do have some concerns about the impact of rising long-term interest rates against some higher multiple technology stocks. If we discount back future earnings on those high multiples using a higher interest rate, it means that the earnings are worth a little bit less. So market's been sorting that out. We'll see what happens. So far, we're holding the support here. This is right up until it's sort of game time before the webcast. And we'll talk about that a little bit more along the way. Seasonally, this is courtesy of Sentiment Trader. We are in and around this point here. Tends to be we get a little bounce and then maybe we get tested a little bit more in the second week of October. But that being said, we're very close to the end of seasonal weakness, if that is in case, of course, what happens. When we look at the type of correction that we've had, it tends to be that when you get a correction, it's an ABC correction, one leg down, a bounce, and another leg lower that's about equidistant to the one that started. So far, we've basically managed that. So this pullback at this point is perfectly normal from a seasonal perspective. It doesn't mean that you don't pay attention. It doesn't mean that you don't do something about it. But at this point, not something to get overly concerned about. Outside of the US, global markets continue to act pretty well. The Nikkei 225 has pulled back a little bit off the highs, but as we've talked about now for a year, we've come out of a bear market that this market was in since 1991. And it's a market that's being accumulated by all kinds of folks, notably Warren Buffett, a big buyer of Japanese stocks, and valuations there are quite reasonable. Also, the Indian market, after a long bear market and a heightened consolidation that took place while the Fed has been tightening and other central bankers, we moved out of that and has a nice uptrend in place. So there are other places than the US that are behaving well. The US continues to be a really important market. We want to watch it. But certainly, it's been having a tougher go. So let's talk about the aggregate bond index, fixed income in particular. Fixed income has been having a very difficult year. Now, as we've talked about, the long-term interest rates in the US declined from 1981 to 2020. We think that was a generational low in rates, and they started to move higher at that point. Bond prices peaked out. The aggregate bond index is an index of various issuers across various maturities, across various terms to maturity. So this has pulled back now 22.8% off the highs. In fact, you can see we've just recently made a new low. We talked about over the last while bonds have been pulling back in price, lots of investors have decided that it was a good idea to be a buyer, because over the last 40 years, every time bond prices sold off, it was a good idea to be a buyer. That is not the case as it sits so far. All of those folks who have moved money into the bond market, which we have been quite negative on now for about 3 years, have been underwater and getting worse. Today, we close at new lows. If I take a look at the Canadian bond universe, again, across a broad swath of issuers and maturities, same thing, new closing lows today. And when we look at the TLT, which is the ETF that holds 20-year, 10 and 20-year US Treasury bonds, the ETF is now down 52.58% since early part of 2020. Now, I know I say this over and over again, but we have all kinds of very conservative investors as clients, and we've steered them away from bonds in general, because the fact is this has been a difficult place to be. If you're down 50% in a bond portfolio of long bonds, that's got to hurt if you're a conservative investor. Sometimes it's as important to know what to steer away from as it is to know what to steer into. So we put this up before, but there's now 3 years in a row of negative returns for bonds, and that does not appear to be changing. Yet money continues to flow into cash and bonds. And on the other side, while we do continue to be in a structural bull market for equities, money's been flowing out of equities pretty consistently. If we compare stocks versus bonds, the S&P 500 ETF versus the TLT, you can see that we are clearly in favor of stocks. This is relative performance, stocks versus bonds. So while we are correcting, we favor stocks over bonds. Let's move on. Commodities. We talked about this for quite some time. Commodity bear market went on from 2008 through 2020, where it reversed. That happened to be around the time rates bottomed. Commodity prices had to move higher. They consolidated during the Fed's tightening cycle. And while we know that for sure we can't say that the Fed is done, the market has decided that likely it is done, and commodities started another leg higher. Now, they've pulled back a little in the last week, but again, let's compare one versus the other. We know that while positioning in bonds is crowded and it's not working, commodities are working, and we have very low exposures in general in the investing community to commodities. Well, commodities versus bonds. So remember, bonds are where assets have been flowing, commodities where they've been leaving. Commodities are outperforming bonds. At some point, that tide has to turn. We prefer to be in a group early and then stay there over the course of a cycle. And we think that that is only just getting going. Commodities relative to equal weight stocks. So the commodities index versus an equally weighted basket of S&P 500 companies represented by the RSP, which is the equally weighted ETF. It's the same picture. Reversed higher in 2020, consolidated over the last year. We took a lot of heat, frankly, for having this exposure, but now week by week, on a relative basis, outperforming stocks. So from a really big picture perspective, we continue to like equities. We think they're tactically correcting currently, but we prefer them to fixed income. When it comes to commodities, we like commodities relative to equities and relative to fixed income. And so they become an important part of the portfolio. So crude oil clearly worked its way higher after a long bear market. This is something we can't forget. We talked lots about it. Aluminum, after consolidating after its first move higher through the Fed tightening cycle, turned higher. Iron ore, after consolidating after the first Fed cycle, turning higher. My guess is that copper will be the next commodity to break out of this consolidation range higher. But we'll have to wait and see. Commodities are in the very early stages of relative outperformance versus stocks. Nothing changing there. Now let's talk about the dollar, because the dollar is a bit of a wrecking ball currently. US dollar versus a basket of world currencies has been appreciating. In fact, we've had 11 weeks in a row where it has been rising versus the yen and the euro and the pound, and of course, Canadian dollar. Markets don't like when the big parts move quickly. So a quickly appreciating dollar can tend to put pressure on risk assets. And far be it for me to guess when an uptrend ends, but we do look for clues. When we look at the rally in the US dollar through the course of the bear market in 2022, several times on a relative strength basis became overbought. And in each case, the pressure came off the dollar. The stocks had a bounce. Well, as we sit today, we got to the most overbought the dollar has been since the market made its low in October of 2022. So we'll wait and see. That may be relevant, but certainly something to keep an eye on and not get too bearish. The other thing that the market doesn't like is quickly rising yields. When yields move up quickly, it creates consternation. People worry, why is it that yields are moving up so fast? We know that there's been a sharp move higher on the 10-year and on the 20-year bond, and the 30-year bond. Today, we're pushing just about 5%. Now, a couple things I'll highlight. First of all, again, we are the most overbought on a relative strength basis since yields peaked out in October of 22, again, where the market put in an important low. Here we are today, even more overbought than we were in October of 22, and yields are pushing close to 5%. And of course, if you go on Twitter or you watch the news, there's discussion about this everywhere. Now, I don't want to minimize the importance of long-term interest rates. They have a lot of impact on a lot of people. When we look at the 10-year yields going back to the late 1700s, we know actually that the average long-term yield was around 5%. But we also know we've had a very sharp move higher to get to 5%. Let's look at the last cycle for long-term interest rates. It started in the late 1940s, went to 1981. They did have some sharp moves higher, but it didn't move straight higher. Eventually, higher rates slowed things down, slowed down inflation, and you got some respite for 2 or 3 years at a time. Then you had the next big move higher, and then you had respite. And then you had another move higher, then you had respite. And then, of course, we had the parabolic inflation of the 1970s. Look, this move that we've seen is the biggest increase in interest rates from the lowest level in history, and it's not going to go straight higher either. So I heard Rick Santelli yesterday go on his rant, and I think it's really important for us all to consider how much debt the U.S. government has, how much debt the consumer has, what an impact that can have in certain parts of the economy and the market. But let's not forget for a moment, rates didn't go from the teens to zero in a straight line. There were a lot of cycles along the way, and this one is probably not going to be any different. Okay, so let's talk about what we're seeing going on this week. We know that our job is not to be everywhere. At Barometer, we're very clear. Our job is to identify the asset classes and sectors and themes that we think are benefiting from the current structural backdrop, focus our attention there. Ideally, we get there early and we're there for 2, 3, 4 years while revaluation takes place. So we're always trying to identify market leadership. And that doesn't mean being in every part of the market. We don't have to be everywhere. We want to focus in areas that have a tailwind. We want to watch for change. And that's why I do these webcasts. It forces me to be prepared and talk about it and put up pictures to make sure that they make sense given what we own in our portfolios. And if not, we have to be prepared to make change. And if you get into an environment where nothing's working, well, you probably have to play some defense or have some cash on the sidelines or avoid certain parts of the market. So everybody does things differently. We're quite tactical. We don't think that somebody wants to sit through a prolonged bear market invested, being just a long-term investor saying, well, let's hope for the best. We have 3 basic tools that we use. We have our top-down work, which is my focus. trying to look at all of the various neighborhoods we could invest in across asset classes and sectors and themes to try to drill down and identify those that have a tailwind. And we'll talk about how we do that. And then we try to identify specific securities from our investable universe of single securities that best help us to exploit those themes that are leadership in the market. 70 to 80% of return comes from getting to the right asset class and getting to the sectors and themes that matter. 20% of return comes from finding the securities that have something changing for the better that make them better than their peers. Now, of course, the third piece of our strategy is very disciplined selling strategy, and that comes in handy in periods like we've been going through over the last couple of months. So the top-down work is driven by the fact that in a bull market over time, a broader and broader universe of securities participates in a rally. If a sector is in a real bull market over time, a higher and higher percentage of stocks participate, starting with the leaders, going down to the weaklings. Eventually, you get to a point where almost everything's going higher, and we know probably they don't all deserve to be going higher. So we want to watch to see when the weaklings start to lose steam, while maybe the leaders or the generals continue on. Now that should sound familiar because some large cap tech has been maintaining strength in the market, while lots of things underneath the surface have not. And we've been watching deterioration since August. When we see weakness in the market in our breadth models, it means two things. It means we stop putting on new positions. It means that we go back and tighten up the stop losses that we keep underneath our existing positions, so that if in fact they start giving up their gains, or in fact move into a small loss, we're going to move to the sideline. Excuse me. Okay, so the beginning of August, we highlighted that some of our short-term indicators, percent of stocks trading above the 50-day moving average, percent of stocks with positive weekly momentum, just getting over a chest cold. Percent of stocks making new highs versus new lows, percent of stocks trading above their 150-day moving average, all had started to show some weakness. This was a cause for us to be more cautious. As we sit today, you can see more red on the screen. Percent of stocks trading above their 50-day moving average has now moved down to the low end of the range. Actually, just only about 20% of stocks on the NYSE are above their short-term moving averages. Percent of stocks in long-term uptrends has been deteriorating. There's still some great-looking companies, but there's a bunch that are not acting well in specific sectors. Percent of stocks with positive weekly momentum is actually getting down to the very low end of the range where we tend to see it reverse. So we're watching for that. Percent of stocks trading above the 150-day moving average has moved down to below 50%. So we're seeing deterioration across a broad set of metrics. But it doesn't mean everything. There are some very clear groups that have been losing. A lot of them are those groups that are tied to the bond market, which of course has been weakening now for a couple of years. So I'd like to touch on leadership, but it is as important to know what to avoid as it is to know what to buy. When we get into a market like this, we want to be very clear. We want to stay away from the things that are broken. Now, I use point and figure charts. They help me organize and recognize inflection points. This is a point and figure chart of the utilities sector ETF. On a point and figure chart, when price is moving higher, you mark it out in X's. When it starts moving lower, you mark it out in zeros. And you can see it marks out a very orderly set of higher highs and higher lows. That's an uptrend. This is 2020 through 2022. But in September of 22, as the bear market was really grinding down, utilities rolled over. Now, interestingly, you can see that since then, they put in a series of lower highs and lower lows. In September, we took out 4 previous lows. So if you had any utilities exposure left, which I think we had 2%, we had Nextera Energy, it was time to go. Now, these are seen to be defensive sector. They're companies that pay high dividends. They're not economically sensitive. They're very predictable. So when you're in a tougher market, which we were in September, it doesn't really make sense to be selling the most defensive assets. But we, as we talked about, have had very little, and it's just time to go when it's time to go. This is what that looked like, the utilities ETF from September of 22, the end of 23, May of 23, August of 23, taking out those lows. So sometimes this is where a value buyer wants to step in. We are not value buyers. I think that something, once it's in difficulty, is very hard to know where the bottom is, whether these are seen as defensive securities or not. Now, this was as of the beginning of September. Look what came next. So as of yesterday, over the previous month, one of the most defensive groups in the market, the ETF falls from $65, well, to about $54. And it's bounced a little bit today. This is a broken price pattern. This is something you want to stay away from. Using stop losses saves us from these difficulties. Now, I think there's an interesting message in the market. Whether you're looking at utilities or consumer staples, which closed at a new low today, just in the last 2 months, moving from $76 to $67. Most people buy these for the dividends. REITs, telecom, infrastructure. These are all highly defensive sectors that have a tight correlation to the bond market. If you buy this for a yield and yields in the bond market are going up, then in order for yields to go up, price has to go down. So the most defensive sectors, the ones that you would expect to do well if we think there's a recession, are the weakest performing sectors in the market. Now, the other group that's been hurt by high interest rates are the highest multiple stocks, the ones that consume capital, in other words, always need financing, and those where people pay a high multiple of earnings, which means you're paying for earnings way off in the future. You might have to discount back to the present. So there's biotech, which you can see relative strength has been collapsing now since the beginning of 2022. The last group that's been very, very weak has been the consumer. And we started seeing relative weakness back in February and March. And that's as rates were really starting to move higher. And of course, higher rates impact the consumer when it comes to credit card debt or to mortgages that might be rolling over, especially here in Canada. But relative strength has been very poor. This is the travel and leisure ETF. And people are spending money, but the question is, how long can they continue to spend money the way that they have? So all of these groups are important to stay away from. Obviously, higher mortgage payments are going to mean a consumer is going to have less money to spend. So what is holding up? Well, if we're headed into a recession, probably not economically sensitive groups. But surprisingly, this is the TSX Energy Index. This is coming out of a bear market in 2022 and consolidating what the Fed was tightening. This group is behaving exceedingly well, probably because oil prices also came out of a bear market. They were in from 2015 and are marching higher. So again, this is against a very difficult market. We always have to test and say, do our positions continue to make sense? And given what's happening in the market over the last few days, last few weeks, this group is behaving exceedingly well. Now, part of it is that we have really low inventories in the market, and that President Biden has sold off the U.S. Strategic Petroleum Reserve, which is now lower than it has been at any time since 1982. But a big reason is because these companies are generating a boatload of cash. These are all companies that we have exposure to, and they are all generating very substantial free cash flow yields. What does that mean? It means they have cash to invest in the business should they want to. They have money that they can buy back shares. They have money that can pay dividends, and they don't need the bank, and they don't need higher interest rates for financing. So this makes this group particularly attractive. We think it means we'll see very substantial dividend growth. Dividend growth and rising interest rates tends to be a good place to be. We talked about how energy had started to outperform large cap growth stocks since the middle of the summer. Here's another chart for you. This is the energy ETF XLE versus the equally weighted S&P 500. Now, when people say to me, well, energy is only 5% of the S&P, well, it's only 5% of the S&P because it's underperformed for a decade or more, 14 years. Had a first leg higher in 2020, consolidated while the Fed was tightening. Look at this. We've just broken the trend versus the S&P going back to 2008. So if you want to find a group that's outperforming and may outperform for an extended period of time, this is a pretty good place to start. And that's why energy really is about the biggest weighting that we have in the firm. And it continues to bear its way out. These are live charts as of today. So lots of exposure here. Materials. We talked quite a bit about materials. These are companies that produce everything from iron ore to copper to uranium. Companies that went through a commodity bear market and didn't invest in new capacity because it wasn't profitable to do it. And they also continue to behave quite well. We've seen a series of higher lows, and they aren't going straight higher for sure, but trading above, nicely rising 150-day moving average, nicely rising 200-day moving average, and hanging in quite well against a tough tape. We talked about financials and the fact that insurance continues to be the leadership. So Fairfax would be a poster child for us for the types of things that we own. We own Fairfax, we own Progressive, both are property and casualty insurance companies. Berkshire Hathaway would be one we could own, but we don't. We own Fairfax instead. It's really a Canadian apostle of Warren Buffett. But this group continues to act quite well. We own very little in the banking sector, except for the granddaddy, JP Morgan, which has continued to do quite well relative to market, trading better than 83% of companies in the S&P year to date. And if we compare JP Morgan versus on a relative strength basis versus the big banks ETF KBE, we're very close to making new relative highs. So, but not a lot of bank exposure. And frankly, this is very unusual for us. This is the Canadian equally weighted bank index. You can see relative performance has been flagging now for a year, and today making new lows again after coming down a lot, has come down more over the last week. As of today, we have a 0% weight in Canadian banks. We did have a small position in TD, which we shot this morning. So unusual. This is a very big part of the Canadian market. Financials in general, a big part of the market. S&P and TSX. But something is really bugging these companies, and we would like to see things start to get better before we have capital at risk. So that leaves technology to talk about. This is the XLK, which you can see is made up of the biggest of the big technology companies. It has had very strong relative performance through 2022. But in May, June, relative performance started to flag a little, but there's some wonderful companies in this group. They have pulled back, the ETFs pulled back from $181 to $162, trading above the 150-day moving average and the rising 200-day moving average. But it has broken this trend it did put in this double top. So as we've talked about over the last few weeks, we have reduced our exposure to technology. Yesterday, I wished we hadn't. Yesterday, we had a very weird day in the market. The big 7 technology stocks were up. Everything else was down. Market wound up flat. The average company down 1.7%. However, the ones we own are acting well. NVIDIA trading better than 99% of companies in the S&P. This is the second or third biggest position in the firm. And in the communications group, Meta Platforms, 24% of the CTF, continues to act very, very well, better than 98% of companies in the S&P, and continues to see rising relative strength. Both of these companies generate cash. Both of these companies have lots of opportunity for growth in AI, and you can see, big earnings expectations going forward. So we will see. But I will say yesterday was a very weird day. I finished yesterday and went back to go through my work and was shocked at how many stocks behaved poorly and how few stocks acted well. I knew intuitively, but here's the data. 78% of the S&P 500 companies were negative for the day. The average decline of the companies that were down was 1.7%, yet the index was flat. And it was flat because some very large cap tech performed quite well. We've put this up before. This is one of the reasons we've reduced our weighting in technology, because as the 10-year treasury bond has sold off, it tends to be these kind of move together, but large cap tech has been defying gravity. Now, on one hand, I do understand some of the very largest technology companies generate a lot of cash and need no financing. So in fact, when I say we've gone from a world where the borrower was in control until rates bottomed in 2020, and now the lender is in control, effectively some of these companies become lenders. They're companies that can raise dividends. They're companies that can buy back shares. That's positive. But this is a risk. Either we need to see the treasury bond bounce, or we are going to see some of the large cap tech come down. The net result is that when we look at our weightings, we're about 13% tech versus the index at 28%, despite the fact that many continue to act well. This is enough cause for concern for us to be cautious. So from a weighting perspective, financials continue to be an important weight. We're an overweight, but most specifically in insurance. And while they pull back a little bit, they continue to be in solid uptrends. Energy is about a 4 times weight, the S&P weighting. Now, the Canadian market has a larger weight in energy, so this is not an overly oversized weight, but this is a group that is generating a lot of cash and performing well. We do have some dry powder. Across the firm, we have 10% cash, 9% in short-term government bonds, and 7% in short-term corporate bonds. So if we add that up, that's like 26% of firm assets in dry powder. And we do expect that we'll be putting that to work over the next month or so, but we need to see our short-term and long-term indicators start to improve. Materials, importantly, continues to be an overweight. But the defensive sectors, very low weightings. Communications, consumer discretionary, consumer staples, real estate, and utilities. The weakness in these groups really is not impacting us. So this is all about putting one foot in front of the other. A lot of the money that we manage is income focused. And to be clear, as it has been now for about a year and a half, we continue to favor dividend growth over high dividend payers or bond holdings. This is a chart that is the relative performance of the RDVY ETF, which is made up of companies with an inordinate ability to grow their dividends, versus the FDL ETF, which is the high dividend payers that tend to have low dividend growth. So we can see that as we've been progressing, as rates have been going up, the relative performance has been in the hands of dividend growers and continues to be quite attractive. So our income portfolio has a dividend yield of about 2.6% versus the S&P at 1.9%. But a 1-year dividend growth rate of just over 20%, a 3-year dividend growth rate of just over 15%. We think in a world of rising rates, a rising dividend stream is something that is most attractive. We're going to get total return in form of rising stream of income, and we should get appreciation in share prices. That's exactly what happened through the 50s and 60s as rates went through their 20-year rise at that point. Okay, so volatility is up a little bit from the lows we were at over the summer. We are still substantially below where we have been at significant points of weakness in the market, certainly way lower than we were at in the 2020 sell-off, but we're watching it. Credit spreads continue to be very benign. There doesn't appear to be a lot of concern that corporations can't pay their debt. This is investment grade, and this is high yield. We would expect if there's pressure on credit, that credit spreads would start to rise, meaning that investors were demanding a higher rate of interest to take on the risk that they take on loaning money to a high yield lender or to a corporate issuer. No sign of that at this point. So balance sheets are in pretty decent shape. And of course, we can see that companies that generate cash flow are behaving much better than companies that borrow money. And we're really targeting that cohort. Seasonally, we're headed into the stronger period of the year. Nobody's happier than I am when we get to the second week of October. And more often than not, markets start to perform better. As we go through early part of October, it tends to be a period where mutual fund managers do tax loss selling in the US because their year ends are at the end of October. Analysts, mea culpa, if they're thinking that perhaps they've been too aggressive with their numbers. Actually, interesting, earnings estimates bottom up for companies have been going higher into year end, not going lower. And this piece of data I thought was interesting, and it's just always more entertainment than market decision making. We know going back to 1961 that any year where the market was up January to July over 10% and then had a negative July and August, 10 for 10 had a positive fourth quarter. So let's see. We like the positioning that we have. We're not really adding anything at this point. We'd like to see some of our breadth indicators start to show some improvement. Things start to get worse. We'll certainly take off more positions. But as we sit right now, we continue to think we're in a structural bull market and that ultimately over the next period of time, we break out to new highs. And what comes next is what rewards us for going through some of the anguish we go through investing. So if things get worse, we'll play defense. But as we sit right now, looking forward to the later part of October, and we'll work our way through this step by step. So Pamela, if there's any questions, certainly happy to answer them.
Thanks so much, David. Yes, we have a question here from Alejandro. He says, good afternoon, David. If the 10-year US Treasury bond goes above 5% and oil rises above $100, do you think the S&P 500 could break the actual technical supports and reach the historic long-term floor of 200 weekly moving average?
Well, certainly that's possible. It depends on how rates get there. And somebody asked me last week and I had a smug answer. We can get there eventually. We're just a whisper away from 5% now in the 10-year. Let's see if I can share my screen with you. Share. Excuse me. So you can see that we're at 480 on the 10-year, 30 years closer to 5. It's, I think, 493 on the close, something like that. It would not surprise me to see it go to 5 or 5.25. If it goes there in a hurry, it'd be an issue. But I think that a lot of the economy can handle it. Yes, mortgage rates have gone up a lot. But a lot of U.S. investors, U.S. homeowners have 30-year mortgages. So it actually impacts a small percent. In Canada, it can have a bigger impact. So, can the market pull back further? Of course it can. We got to wait and see. If we look at the 200 week, it's way down here at 3,900. I don't think it's likely. You got to see what happens at the 150 week and through the 50-week moving average. That's not my guess, but I do think we're in a market where you need to be sort of targeted, and I think you need to be open to all of the various possibilities. We are not all in one spot. We're diversified across a few sectors, and we've got some cash and dry powder, and and we'll see what comes, but we're not going to guess at what might come. At this point, we do not have much by way of anything other than very short-term bonds, which effectively are like cash in fixed income markets, and we'll see if the market starts to broaden out.
Thanks so much, Dave. Next question is on pharma. Thoughts on Eli Lilly and whether Barometer is still invested in that stock.
We really like the obesity drugs. We think it's one of the biggest problems in the U.S. Healthcare system. We also, particularly like Weight Watchers, because Weight Watchers, was smart in recognizing that if they focused on their program and then also offered prescription services for these obesity drugs that might go hand in glove. Interesting, James Callahan was on BNN yesterday talking with Anwar about Weight Watchers and the fact that there have been a couple of rulings in the last month that insurers will pay for the obesity drugs only if people show a real commitment to trying to lose weight through other forms. So fits perfectly with Weight Watchers. They can sell their programs and work on the obesity drugs. So I think it's an interesting area. There's some other big drugs in approval right now that could be significant in Alzheimer's and in cancer care. So at some point, there may be other opportunities that we see, but in general, we're very targeted right now in healthcare.
Thanks so much, Dave. Could you give us your opinion on the US dollar versus the Canadian dollar?
Yeah, so it's a tricky one. The historical correlation is Canadian dollar to oil. But we have a government in Canada that has been not very friendly to energy, even though we're not going to be able to move away from it anytime soon. So there is some question as to whether that correlation can hold up. I think there's also some question as to whether the Canadian economy can support the kind of high interest rates that we have right now, given the fact that the consumer has far more debt than a U.S. consumer. And we have a lot of mortgages resetting because our mortgages tend to be much shorter terms. And so the combination of those two things mean that it's possible, interest rates might have to come down in Canada sooner, which could put some pressure on the Canadian dollar. So I tend to believe that the Canadian dollar follows a commodity cycle, but we're moderating that view given the circumstances of the consumer credit.
Dave, the next question comes from Lawrence. He wants to know whether you are shorting or buying contra ETFs.
Shorting or buying contra ETFs? No.
Okay.
We don't. We tend to either purchase the long ETFs or short the long ETFs. We don't tend to use the counter ETFs inverse.
And
we don't think that the mechanics work as well for investors.
Right. The final question comes from Peter. He is curious to know your thoughts on why the current end of summer rally in 2023 is not a huge double top versus the continuation of an upward channel.
Well, the way that I look at it right now is that it doesn't look that way. I think that there is some risk that the NASDAQ is going through a double top, and that would have an impact on the S&P because some of those companies are really, really big. My own view, and this is not the house view, my own personal view is that it is going to be hard for technology to continue to lead the way that it has, given that we're in a different condition. There are alternatives for cash flow generating investments that are very, very inexpensive. So tech is pretty crowded. Everybody's there. If you wanted to have tech exposure, you got tech exposure. So Is it possible that money could start to rotate away? Yeah. We're seeing relative strength in energy outstrip relative strength in technology. If you put tech and communications together, include Google and Meta, that's 35% of the S&P. If the tide goes out for a little while there, it would have an impact. Now, we're underweight. We do own the absolute leaders. My opinion is we're going to change that unless they start to behave poorly. But they certainly aren't cheap, and they certainly are well owned. And it hasn't been historically that they do particularly well when rates are rising. So if the TLT can find a bottom, meaning the bonds find a bottom and can rally some, which could happen at any time, that means they can continue to do particularly well. We just got to continue to assess it. But I don't see at this point, if I look at the longer term picture of the S&P, I don't see a double top. Every cyclical bear market in history at some point comes back and has to challenge the old highs and get through them. So we'll see. But at this point, what's going on now doesn't look anything like 2000, or it doesn't look anything like 2008, which is what was, heading into secular bear market. So, I can't make that comparison.
Thanks so much, Dave. That's all the questions we've received. So I leave you with the final word as always.
Well, I appreciate everybody tuning in. Part of the reason we do this is selfishly, it forces us to be prepared. And it helps us to communicate with clients and help them to understand what it is that we're doing and why. But it also helps us to explain, the way that we look at the world. If you have questions that we haven't answered, and there's lots of them out there, give us a call, shoot us an email, send a text, direct message me on Twitter. I'm happy to jump on the phone and have a conversation. And so are all the investment counselors at Barometer. Our job is to grow the business, and we want to continue to talk to more people over time. So thanks very much for tuning in, and hopefully it was useful. We'll see you next week.